Regulation crowdfunding was really just coming more into kind of the mainstream where more people were becoming aware of it. Because of that, it actually doubled almost every year for 3 years, grew 6.8x in investment volume from 2018 to 2021.
How do regulations protect investors?
In the US, 99.9% of all businesses are small business. That's huge. But then you think about the impact on how much they produce. Over 43% of US GDP. So almost half of everything the economy produced in 2022 was attributable to small businesses, as were 63% of net new jobs from 95 to 21.
In the US, as well as some of the territories, I don't think it's going to be any surprise. California, Texas, New York, Florida, and Pennsylvania. These are the primary states where crowdfunding is happening.
VC startup fundraising, what we've seen since the 2021 peak is a huge contraction, right? US, so United States VC funding shrank 53% from 2021 to 2023. So what we saw was this big pullback. Now, when we take a look at regulation crowdfunding as kind of a proxy to that venture capital investing for deploying capital in small businesses and startups, we see a similar trend. However, there's a few things you will notice. First, during that 2018 to 2021 time period, there was this huge growth, right? A lot of this time was when regulation crowdfunding was really just coming more into kind of the mainstream where more people were becoming aware of it. Because of that, it actually doubled almost every year for 3 years in a row. So it grew 6.8x in investment volume from 2018 to 2021. You can also see in this chart, the breakdown between equity here in the purple, versus debt deals in the kind of teal color. So what that means, equity investments, right, are common shares, preferred, safes, convertible notes. Those are all kind of lumped under equity. Those are a little bit different deal structure than the debt offerings. 2024, just to give everyone an idea of some of the averages that we're seeing across all the deals that have launched this year. So the average deal that has successfully been funded has tended to raise around $362,000. Now, from the investor perspective, the average check size has tended to be around $1,000 to $1,500 per investment. So this means each investor is investing that on average. And again, 1,440 has been the average so far this year. There's been an average number of 273 investors per campaign. And then the average campaign has tended to last about 121 days, right? So about 3 to 4 months typically on average. Now we look at kind of break it down versus equity versus debt risk. We do see a little bit higher risk in the equity deals so far. So we've seen these equity crowdfunded deals tended to have a closer to 8% average failure rate for the companies versus a closer to 4.7% failure rate for the debt deals. But comparing all of this, right, big picture, what does this mean? If you look at traditional venture capital angel investing, even if we're assuming that some of these numbers are end up being closer to a, say, 10% failure rate, that's significantly lower than what a lot of venture capital tends to be. So some sources cite VC as having as high as a 75% failure rate to return any cash to investors. And if you look at some of the BLS data for small and mid-sized businesses, tends to be around 50% of companies failing after 5 years. So taking all of this into account, again, those regcf and Reg A Plus markets do actually tend to be pretty robust so far and are providing interesting opportunities. regcf helps to unlock because a lot of times, the traditional angel investors, venture capital gatekeepers are less diverse. They've been less diverse historically. And what regcf does is it allows you to raise from people online, from your community, from your investors, from your customers. And it can be people who, quote, look like you, as well as other people who don't, but who believe in you. And so I think that's one of the real advantages through regcf that it unlocks.
How do regulations protect investors from potential fraud or misrepresentation on regulated crowdfunding platforms?
I mean, the regulations are designed to offer investor protections. They're there to help facilitate capital raising, but part of those regulations and the disclosure requirements are looking at it from the perspective of making disclosures to investors. Those disclosure rules are very specific about what a company doing a crowdfund offering has to disclose. They are subject to the fraud provisions of both the federal securities laws and the state securities laws. So I think from that perspective, the securities laws, part of their in existence being is to also offer some protection to investors.
You know, there's other things that the regulations do, puts limits on investors, bad actor checks, you know, helps to kind of set up the expectations among the funding portals. But it's the transparency and the disclosures, and it's making sure that investors have all the information so that they can make, right, an intelligent decision on their own as well.
This association was formed immediately after the 2012 Jobs Act passed and was signed into law by President Obama. We've been here from those earliest days, and our members have been actively involved in getting that law passed. And so this is a community that includes new members, people who are newly interested in crowdfundings, entrepreneurs who are raising capital, new investors who've never had an opportunity before to invest directly in private companies, and some of the OGs of crowdfunding who've been around working to see this law passed and who utilized prior to its passage some of the more arcane exemptions allowing for crowdfund style investing and capital raising.